Okay, hello, good morning. It's a pleasure to be here with you for this report on the third quarter of the year 2024 about Leblon Equities Fund. We'll talk a bit about Leblon, our investment process, a bit of the outlook of the market, talk about what we changed in the fund, and have two investment cases that we're going to discuss. So about Leblon, just as a reminder who we are, we created the firm 16 years ago. Last week, we celebrated 16 years, always focused on Brazil, on Brazilian equities. We have a culture of transparency and meritocracy, and the partnership has today 10 people. We believe in this alignment of interest between ourselves and our clients. 50% of the wealth of all the employees and partners of Leblon are invested in the funds that you can buy. We have 22 people today in the firm being 10 partners. In the investment committee, all the 4 fund managers have more than 25 years of experience with the Brazilian equities. As a reminder, we are value-oriented with a bottom-up research, long-term investment strategy, and we believe a lot in stewardship, in being present in the companies we invest in a collaborative way. Our track record, as a reminder, has been 5.4% per year in these 16 years, in a period when the Ibovespa in dollars was up only 2.8% per year, and the MSCI Brazil even less. On the next page, we have the picture of our partners today, the 10 partners, Pedro Sherman, myself, Bruno Pereira and Marcelo Aguiar, the 4 portfolio managers at the top, with Pedro Rude, who is the partner responsible for control, and the other junior partners also supporting the investment decisions and investor relations. Our philosophy, as a reminder, we believe in the long-term fundamental reasons for the performance of firms, which is mainly the ability of firms to find interesting capital allocation opportunities above its cost of capital. We believe in people and the alignment of interests of these people to us as investors. We like businesses that have moat, or let's say protections, like brands, trademarks, and things that the people cannot replicate easily, systems and processes. And we believe in the buying at the right price. Not always a great firm is a good investment if you don't find it at the right price. We are not short-term oriented. We believe that short-term EBITDA, quarterly results, etc., management speech is just the reason for the volatility that creates the opportunity for us to go into these long-term trends. So, as I mentioned on the other page, Sherman is the CIO. Myself, Sherman, Bruno Pereira, and Aguiar are the 4 members of the investment committee, the 4 portfolio managers. We work in teams of 2 analysts at the sector level. So Sherman works with André in retail, with Stefano in TMT, with Gabriel in education. I work with André in consumer goods, with Gabriel in healthcare and energy, and Lucas in transportation energy, and Nuno with food and beverage, and Bruno Pereira with Gabriel in insurance, and so on. Our assets under management today around 1.2 billion reais. It's mainly half in 41k type of funds, like in insurance companies distributing long-term retirement plans, family offices and fund of funds 20%, high net worth individuals 12%, digital platforms 11%, pension funds 11%, and the partners' money is around 10 to 15% of total AUM. On our investment process, I think it's interesting to highlight today to you. I mean, this is a picture of our screening tool that we have been developing over the last few years. It's a way to create an algorithm that basically replicates the way we think, and basically trying to put on a mathematical way the importance that we give to the factors that we believe are important when analyzing a company. So on the top, I mean, we have a big square of quality features, and on the bottom, the valuation features. You see that the valuation is very important. We have to buy things cheap to make sense of the investments. When you look for quality, the three big groups of quality features have to do first with the moat, or let's say the track record, sector dynamics, basically of the business, the strategy of the firm. Then we have capital allocation issues that have to do again with the sector dynamics and the track record of the management. And finally, quality related to alignment of interest groups, so the type of shareholders, the board members, the culture, the management, what they're doing about ESG, etc. And then we look about valuation. On the bottom, you see that the DCF models of Leblon analysts is the bulk, is 1/3 of the overall valuation box. We also look at the consensus in the market, but of course our views when they are different from the consensus is when basically we find interesting opportunities. And we look multiples, future multiples and some past multiples related to cash flow and earnings, etc. So the size of the boxes is the weight of these factors or these multiples or this DCF in the overall ranking that we put the stocks on this system. So just as an example, this example of Priner. Priner is a valuation 1, which is a green. The green is 1, the yellow is 2, and the red is 3. We try to give this 1, 2, 3 relative positions to all the factors. And Priner has a 86% upside to our target price, to our fair value today. And it's a company that on the greens, it's a top quartile of quality, let's say, and valuation, where it's yellow, it's a second quartile, and let's say in red is the third quartile. So on a last 12 months PE basis, Priner does not look very attractive, but when we invest, we are looking for the future. So that's why we give more importance to the future multiples and to the DCF than we do to past multiples, which is more of a type of reality check on things. And Priner, for example, is yellow in terms of sector dynamics because it's a very unconsolidated sector. Priner is a market leader, but with a very small percentage of the overall market share. And the main clients are very large companies that have a lot of pricing power. And of course, this dynamics of being in a pulverized, or let's say with a lot of players type of competition with the big clients is not the ideal situation. But that's compensated by the fact that it has very good management, very good track record, very good strategies, growing a lot with a lot of acquisitions, and is trading at very good valuation. So that's why we like a lot the case. That's one example. And on the next page, we have the same system that we input data on companies on a bottom-up level. It delivers this screening where we compare all the stocks. And again, so on the top of this pyramid, we have like companies with quality 1 and valuation 1, so they're very good and very cheap. And these are usually the stocks that should be in the portfolio. The stocks in the red at the bottom are like quality 3 and valuation 3. I mean, means these are not very good companies and very expensive. So these are stocks that should never be in the portfolio. And this is a reality check again, because this screening tool is a way to highlight to us, a red flag to us on a daily basis on the movements, the relative movements of all the universe of stocks in terms of quality and valuation. And that's a support for quicker decisions on the portfolio that we would make just with our mind's algorithm. And this system algorithm that replicates how we think in a way that make us be, that supports our discipline, let's say, and our speed of decision. And again, this system is interesting to us because it delivers many different ways of looking the portfolio from different perspectives on the different factors that we can choose, like quality of management, see the portfolio by type of risk factor, like quality of management or sector dynamics, whatever, or PEs or upside to target. And not only we can do this risk screening in a more disciplined way, also the system helps us understand like the weighted upside to the portfolio. So today our portfolio implies around 70% upside to the fair value of the companies we have in the portfolio. And we can understand from where this upside is coming from in terms of the different stocks in the portfolio. So it's quite an interesting tool that we have been internally developing over the years. On the next page, in terms of outlook for the market, next page, David. So the reason why stocks in Brazil are very cheap is because mainly interest rates are very high. As you can see, long-term interest rates in Brazil right now is like 6.5% in real terms above inflation, which when you compare to other countries in the world is one of the highest. And when you have your cost of capital very high, of course, the alternative is bad for the valuations. I mean, when you look in another way, in the opposite of the inverse of the cost of capital that we showed before is the price earnings for the market average, or the Ibovespa. And when you look on a PE basis, in this chart, you can see that the Ibovespa is now trading one standard deviation below the average of the last 20 years. On average, Brazil has been trading around 11 times earnings. It's now trading around 8 times. It's one of the moments of lowest PE for the market. And when you look the small caps, it's the same. Again, in the last 20 years, we are in one of the lowest moments or cheaper valuations on a PE basis. When you look again, the small cap performance relative to the Ibovespa index, which is the more liquid stocks, in the last 2 years, this gap increased significantly, with the small cap index down almost 30% and the Bovespa going up 14%. So, and that discount, liquidity discount, has a lot to do with foreign investors that have abandoned Brazil in the last 10 years, not to say maybe longer. But the foreign investors basically focus only on the large caps today in Brazil, and the smaller caps are left to the smaller local players, and that's why this gap of valuation between large and small caps increased over the years, and that's a sign of a bear market. And when we change the mood on Brazil, that will eventually change one day, that gap will close. Another leading indicator signal that shares are very cheap is when you look at the 9 of the top 15 stocks in our portfolio are companies that are doing repurchase of shares. This buyback programs of companies is a very important sign that entrepreneurs and controlling shareholders and insiders, let's say, of the businesses, they believe the best return to their money at this point is buying back their shares that are very cheap. When you look the history of, let's say, market cycles in Brazil, you can see this chart, and basically the moments that you would make a lot of money are usually these moments of a lot of panic, like Lula election and COVID-19 and the impeachment of Collor, the dictatorship years. So usually you have to be contrarian, and if nobody wants to invest in Brazil, maybe that's a good moment to invest in Brazil. And returns usually have been very strong after these periods. So on the performance of the fund in the second quarter of 2024, the fund is up 5.5% in the quarter. In a period, the Bovespa was up 8.5% and the MSCI Brazil 5.7%. Since inception, we are up 129%. In a period, the MSCI is down 8.4% and the Bovespa is up 54.3%. And the Leblon Pipe Fund in the quarter is down 0.7%. The small cap index was up 1.4%. And since inception, the Pipe Fund, the small cap fund, is up 31% when the small cap index fell 18%. So in the quarter, the main contributors to the good performance of the fund was the Lojas Renner, Priner and Mills, and the underperformers were Hypera, Braven, and Brisanet. Renner, good performances after a period of very bad performance. The stock is going back to its, let's say, its average or its trend. The company suffered because they gave a lot of credit in a moment that markets were quite bad in Brazil. The company now refrained from continuing to give a lot of credit to customers, and this cleaning of their balance sheet, let's say, like this, is over and the results are coming better. Priner also has been delivering good results, and the acquisitions and the integration of the acquired businesses is working fine. And Mills, the same, is going into new areas and new type of equipments, and the market likes this diversification, and the company is trading very cheap and performed well in the quarter. On the other hand, Brisanet performance was not very good. I believe this has to do with short-term events. The company is deploying its 5G strategy. It's a moment of high capex and still not many clients paying for the services that the company is investing in to deliver the service. So it's natural when the company is doing a huge capex deployment to have results that are not very good in the short term. But that's part of investment cycle, and that's normal. And we like this opportunity to increase positions in things like this. Brava is going through the merger of two companies, and of course, integration of businesses are never easy and very simple. On the next page, we have the what we increased and what we decreased in the portfolio this quarter. So Hypera is a new stock we added to the portfolio. It's trading around 10 times earnings. It's a company with good brands, scale, market penetration in a very good sector, which is the healthcare, the medicines, and population is getting older, and people, when they have money available, I mean, if you need to spend in your healthcare when you can. In Brazil, it's out of the pocket. Individuals pay for their drugs, not like in other countries where the insurance companies do the payment. So having available money, I mean, as an individual savings to be able to buy the medicines is quite an important factor. And we believe the macro may be improving, and the company has some inventory issues when there is some macro problems, and that's in the past. That's why the company underperformed recently with a lot of cycle of inventories, but now the inventories have been sold and the sales are okay, and the company should start to report again good numbers, and it's trading at very low historical multiples. We like the management, the strategy, the sector, and the company is cheap, so we added to the portfolio. Then we have Priner, Suzano, and Rede D'Or. We also increased those three stocks in the portfolio for I mean, valuation mainly, and also mid let's say time horizon triggers that we believe. I mean, in the case of Suzano, they tried to do some acquisitions internationally, and the stock performed very bad because of that. But we still believe that they have a very strong competitive advantage at a global level in terms of costs, and the strategy is good, management is good. So when the stock goes down a lot, we like to increase there. The same Rede D'Or is posting very good results. I mean, it's going through a very strong capex program to increase a lot of beds, like more than 5,000 beds are coming into the portfolio. 75% of that is brownfield, which implies a very high rate of return on this marginal investment. So short-term results do not reflect the changes that this company is going through in the next few years with all this capex that's being implemented. And Priner, the same, is integrating a lot of the acquisitions. And then we reduced or sold completely Santos Brasil. Santos Brasil announced this transaction where the control will change, and they will offer a buyback for the shareholders. So the current price reflects, let's say, a fixed income on the deal being implemented. It's no longer so much of an equity story, it's more of a fixed income story. And we were shareholders in Santos for many years, and the investment delivered, and there's optionality of an M&A that we always felt might be part of the investment case occurred. And it's good. We are reaping the benefits now of this long-term strategy we held there. Lojas Renner also performed well, as we mentioned, because of this cycle of credit to clients, etc. And we are using this opportunity of a strong performance in the quarter to reduce our stake there. And CCR, the same. And we believed BR Foods and Duratex. These are two stocks that performed well, reached our closer to our target price, and we don't believe that the current valuations, they offer a very strong risk reward type of relation, and we decide to sell those two stocks. So the Leblon fund portfolio today looks like this. The top 10 holdings are mainly Priner with a 12%, Mills 8%, B3 6%, Lojas Renner 6%, Suzano 5%, Ocean Pact 5%, Redditor 5%, Hypera 5%, Natura 4%, and Pactual 4%. So the top 5 stocks are 37% of the portfolio. The top 10 stocks are 61% of the portfolio. It's part of a concentrated fund. We believe that's a unique opportunity for our global investors because we are not very much related to the Ibovespa. Stocks that are mid and small caps are 45% of our portfolio, which they're not in the Ibovespa index, and large caps are 45% and cash 9% of the fund at this point. So it's a bottom-up built portfolio is a stock with stocks that are not easily found or easy covered by global investors that focus only on the more large cap names. Is a way to play Brazil in this mid-smaller names, which I think may make sense as a complement for many of the large global investors that may be playing Brazil only through the ETFs, for example. It's a more active portfolio. And if investors want to really focus only on the smaller cap names, we have this Leblon Pipe Fund, where the largest stocks, Priner with a 23% stake, Mills 21%, Ocean Pact 14%, Brisanet 12%, Grupo Pão de Açúcar 6%, other names 9%, and cash 14%. We can go through these later if you want. We are transparent, and investors willing to understand better the stocks in the portfolio can just call our investor relations team, and we can do one-on-one calls. On the next pages, we have two investment cases, Redditor and Santos Brasil, and I will invite Gabriel and Marcelo Aguiar, both partners, to talk about these two cases today. Thanks, Gabriel.
Thank you, Marcelo. So Redditor is I think it's a good example for us to talk about, because it's highly representative of how we think of investments here at Leblon Equities. So I think it's a good opportunity to touch base on this investment case here with you. So if we could summarize in very simple terms our investment philosophy, it's basically buying good companies, not overpaying, and if possible, being very patient and doing nothing in times of crisis and during bad times. So in the main point, the first point we mentioned was buying good companies. And how do we define good companies? Basically, through these three pillars here. So the first one is moats, which gives companies competitive advantages in the sectors they're positioned, capital allocation opportunities, and alignment of interests. So there's this famous Charlie Munger quote that he says that over the long term, it's hard for a stock to earn a much better return than the business which underlies it earns. So basically what he says is that, for example, if there's a company with a 6% return over capital employed during 40 years, if you buy this company 40 years ago and you sell only 40 years later, even if you bought it at a discount, it's unlikely that you're going to have a return in the stock, a return different from the 6% that from the business. So and that works the other way around too. So if you're buying a company probably not at a discount, but maybe you're buying a fair price, or maybe even overpaying a bit. If this company has an 18% return over capital employed, uh, let's say for 20 or 30 years later, you sell the stock, you're probably going to have a very, very good return on your investment. So, and this is not a theory, this is not an opinion, this is like a mathematical certainty. You can put it into, you can do your math and see that this actually works, and it's quite fantastic. And that's basically why we focus on good companies. So it's not for marketing purposes, it's basically because we believe that in good companies, uh, we can extract the best long-term returns. So next slide. I'm gonna go through each one of these pillars to explain why we think Regidor is a good company. So basically, I think the strongest moat here in Regidor's case is its switching cost. So basically, insurers, what they do, they sell healthcare plans to beneficiaries, and these beneficiaries, they have the right to uh, go to certain hospitals. But the thing is that these people, they usually have hospitals of preference. So if in a hypothetical case, someone were to lose the right to go to a certain hospital, maybe they would be unsatisfied, or maybe they would consider switching their healthcare plan. And that's exactly what happened in 2019. Amil, which is one of the biggest healthcare insurers here in Brazil, they decided to disaccredit 17 hospitals, and many of them were from Regidor. And basically, what happened was that Amil ended up losing 500,000 lives, uh, simply because people were unsatisfied with this right they had just lost. So people value Regidor's brand and their medical network, right? So uh, this example here showed us how strong Regidor's positioning is. And basically 2 years later, Regidor and Amil, they resumed their commercial relationship. And this showed how it's hard to compete, and it's hard for you to extract Regidor's margins. And so this, yeah, basically this shows how we think Regidor is very strong in its positioning in its sector. So next slide is capital allocation. Basically, this is a very important pillar for us because stocks, they're an investment vehicle that they have a very particular characteristic, in that you have automatic reinvestments from your return. So basically, if you're investing in a company and the money they made in a year, they make money in a year, part of that they might decide to distribute it via dividends to shareholders, but another big chunk of it stays within the business for the capital allocators to get that money and reinvest it in other growth opportunities. And this is basically why we think Regidor has a big potential looking forward. And basically is that, as Marcelo mentioned before, Regidor is basically going through a very steep capex capital allocation plan. And basically they're investing billions of reais in building new beds for their hospitals, being the hospitals they already have or in new hospitals. And basically, when we try and calculate what the marginal ROICs are for these investments, we actually see very high returns in relation to the cost of capital. So basically, when we estimate that Regidor is going to spend 1.2 million reais in building a single hospital bed, a brownfield hospital bed, and it takes, I don't know, 2 years for it to ramp up, and you start 2 years earlier doing your CapEx, eventually, once your operation is mature, you have an operation that has over 30% ROIC from that capital, from that initial capital you employed. So these are highly attractive marginal ROICs, and basically we see this as not only very high, but we also see a very long road for Rede D'Or to invest this capital. So basically, the hospital business in Brazil, the sector is very fragmented. Rede D'Or is the undisputed leader with only 7% market share. There are many cities that Rede D'Or hasn't entered yet. So we think there's a big avenue here for Rede D'Or to keep that money within the business and reinvest it at these highly accretive ROICs. So next slide. For alignment of interest, it's very important to mention this topic, because at the end of the day, it doesn't matter if the company has strong moats or competitive advantages, or even a high potential in capital allocation opportunities, if the people that are making these decisions are not aligned with what you want and what you believe for that business. So for Rede D'Or, basically what we want is long-term sustainable returns. So if you have a management that has incentives for short-term results, or is not considering or not basically addressing high risks in certain investment opportunities, basically we have a very critical misalignment of interests. But actually what we see with Rede D'Or is quite the opposite, because you have the founding family. They basically own and operate the company. They make decisions with this long-term vision, which is very similar to what we practice here. So taking that into consideration, and also the way that this founding family decided to compensate the company's executives with restricted stock grant programs, it shows that the company, the owners are aligned with us, and the executives are not only compensated in line with what we as shareholders want, which is performance, good long-term performance, and also the compensation keeps them in-house, because they might receive their compensation only according to the vesting plans. So they're highly incentivized to stay within the company for many years and years, which is actually what we want. So next slide. So basically, we talked about the 3 pillars of what we categorize as a good company, but it's also very important to not overpay. So basically, you might end up having a very bad investment, even if in a good company. So they're not synonymous. So basically, it's important to basically do a sanity check on valuation levels and check if you're not overpaying. And basically, this is what we see with Rede D'Or, and that's why we think it's a very important position here for us at our fund. And basically, in Rede D'Or, if you consider some conservative assumptions, like Rede D'Or delivering the expansion plan they have today, and taking the 12,000 beds they have today, plus the around 5,000 beds they will deliver until 2028, and you consider that this entire stock of beds, they will have 80% occupancy rate, and only 90% of them will be operational, you have a big, a considerable growth CAGR in revenues looking forward. Not only that, if we're conservatively assuming that the hospitals will only be able to readjust their prices according to inflation, and we're considering healthy and sustainable MLR ratios for SulAmérica, which we consider 10 years looking forward with a 82% MLR level, which is above what they practiced pre-pandemic. So basically taking these main 4 assumptions into consideration, and many others, but the main ones are these 4, and putting it into numbers in a 10-year discounted cash flow, we see around 14% of an expected annual return. We're not trying to pinpoint or say that these are the expected returns an investor should have, but it gives us, as we said, a sanity check on whether the returns are attractive, taking into consideration the price we're paying for their stock now. And if you assume that you want to value this company by buying it today and leaving in 3 years, even with a multiple compression. So, for example, you're buying Rede D'Or today at 20 times earnings next year, and then in 3 years, you assume that this company is gonna be worth 16 times next year's earnings, which is what we think this is the fair multiple for this company. Considering the net income growth that it's gonna have in these 3 years and the dividends that you're gonna get along the way, this is a stock that you can get approximately 19% of internal rate of return in 3 years. So basically, this is it. We think Rede D'Or is a good company. We're not overpaying, and now it's up to us to be patient and let these returns compound and continue seeing Rede D'Or to be a good investment and a good return aggregator to our fund as a whole. So thank you.
Okay. Hi, everyone. So let's talk a little bit about Santos Brazil. Just one disclaimer first. You may be questioning yourself why we're talking about the Santos Brazil investment thesis, while, as Marcelo Mesquita mentioned before, we already have like a public offering to delist the company in something like 4 to 5 months ahead. The reason why we're going to talk a little bit about that is because Santos Brazil is a great example of what type of returns we get when the Leblon Equities investment philosophy unfolds. Okay, so let's talk about briefly. So as was mentioned before, I mean, just one step ahead, earlier. I mean, we spoke about Santos in previous reports. Just to highlight that Santos business is mainly the management of the 3 container port terminals that is located in Santos, in the state of São Paulo, in Bituba, in the state of Santa Catarina, and Barcarena in Pará. All the 3 terminals totals 3 million TEUs. And the Tecon Santos, which is the largest terminal, represents 84% of its total capacity. Okay. So we are looking at this slide 2. I would like to call your attention that, I mean, as mentioned before, we look to companies that have relevant moats. So we're talking about companies with sustainable competitive advantages over time, that have a differentiated and irreplicable assets and pricing power. In the case of Santos Brazil, we were looking at when we invest firstly in the company, its container terminal in the port of Santos is definitely a differentiated asset with a high productivity. I mean, you don't build a port terminal in Brazil less than 6 to 8 years. Okay, so at that time, when we're looking to invest in Santos Brazil, The peers of Santos Brazil was already operating at a pretty high utilization capacity, and the Con Santos, which is owned by Santos Brazil, was not as high. The company has a decent pricing power when the capacity of the port is more relevant. Another important characteristic that we look in the company is that definitely the capital allocation, and that Santos Brazil has a very high return brownfield investments in the same asset they own. No, we don't see any company in Brazil investing that type of returns. Again, this is brownfield. A lot of that explained because of that. And the third pillar is the line of interest. And the major shareholder of Santos Brazil is Opportunity Fund. So it's a fund like ours that control around 50% of the company. And a good example how they align with us is this deal that they announced recently. They closed with a CMA, which is a huge global carrier, transocean carrier, and they put a decent price to the listed company, a little bit above 15 reais per share. And also management is totally aligned with around 45% of their, let's say, annual total comp in shares. Let's go to the next slide 3. This is an interesting slide. I mean, again, we spoke about the philosophy on the qualitative side, and now we talk a little bit about valuation side. One type of valuation we look when we invested in Santos in the beginning of 2018 was, let's say, it's just one of them, okay? Like the enterprise value for per ton, okay? Around the time that we invested in Santos, we had an investment or a buyout by a China merchant that bought a terminal in the south of Brazil, where they paid at that time 2,645 per ton. And we were looking at Santos at that time, trading a little bit below 1,000 reais per ton. So besides, let's say, the fundamental analysis that we did and the qualitative analysis, we also had the very interesting optionality, looking at a very large terminal container, the most important port in Brazil, trading at a very large discount to the recent deal, and again, with the shareholder that was aligned with us. Okay, so as you can see, the reprice of the asset was huge through time. Okay, let's move to the next slide. So as mentioned before, I mean, the investment thesis play out better than we anticipated. I mean, we were modeling at that time that utilization capacity would get to around this 80-85, which is a level that ports, container terminals tends to have more pricing power against the carriers. We are modeling that. So that was not a big surprise was price, okay, that drove this huge EBITDA growth through time. Okay, so the pricing power effect when the terminal got to 80% was much, much higher than we thought. So when we invest in the company, they will generate around 200 million reais annually. Okay, and we are modeling now, and they're probably going to deliver an EBITDA of 1.5 billion reais. Just so you have a sense, I mean, when we invested in 2008 in the company, my model was pointing to 800 million reais as an EBITDA for 2014. Okay, so the pricing power was huge from 2021 onwards. The company just in 2021 increased price by 100%. Okay, so definitely this was playing a lot in our favor in the investment thesis. So the last slide of my portion here. So in conclusion, I mean, Santos Brazil has so far provided us a 420% return in this period, 2018 to 2024. We are divesting on our position, as Marcelo Mesquita mentioned. Over time, I mean, we made several tactical moves. So the green circles there, dotted circles, is movement that we bought the shares. The red circles movement that we sold some shares. So we never divest fully. But again, if we were more, let's say, short-term invested horizon style, we would have lose or lost a lot of the upside that we saw, in the last, let's say, 12 to 16 months. The biggest move we did, it was one of the best moves we did on the investment side of the on Santos on the COVID. Okay, and the COVID we saw a huge, depreciation of the shares. I mean, the shares was trading close to 7 reais. It came down even below the price that we paid when we first built a position at 3 reais per share, and then we more than doubled the position there, and the Santos was like top 3 of the portfolio. Anyway, so that's the type of investment philosophy and how it could play out in terms of return for investment fund when our thesis is proven, and we stick to that stock for a while. Thank you very much for attention. So I pass the floor again to Mesquita to finalize the call.
Great. Thank you very much, Aguiar and Gabriel. Let's see if we have questions. Yeah, I think we have no further questions, so we will end up this call. And if you ever see this video and want to contact us, please feel free to do it. We are very happy to help you and go in more details on any subject you may require. Thank you very much. Bye-bye.